Hey guys, Sebastian here from HotForex. We did a workshop the other day and unfortunately it didn't record. So I know a lot of you guys missed it because it started a little bit later than anticipated with guests arriving caught in traffic. So for those of you who were at home who missed out on seeing the presentation, I'm just going to re-record it now quickly and show you what we went through. Also, I'm going to load a secondary video after this to go through the actual simulations that we did at the end of the Traders Workshop. Okay, so the agenda, it was time frames and candles, support and resistance, trends, some money management, stop loss and take profit. I'm going to show you the calculator that I use, also some expectancy, trading results, and then a brief introduction to our price action bot and vol trader. I'm not going to spend too much time on that. I'm just going to focus on the key stuff for this recording. Okay, so first things first is the candles and time frames. If you have a look at the green candle, what this is telling you is a lot of good information. So what you're getting out of this is price and you're getting time. Now these two ingredients are extremely important when you are deciding to take a trade, because we base a lot of our trades off price action. We believe in price action more than we believe in indicators as such, as all indicators are built from price and time, and some have volume in them as well. So when we look at this green candle, it's a bullish candle. It means that the price opened low and it proceeded to close higher than it opened, hence why it's green. But there's more information in this candle. What we see is there's a low and a high. So when it opened, the price went down to the low, maybe went all the way up to the high, and then retraced a little bit and closed, but it still closed higher than when it opened. So that means the bulls won. The buyers were more dominant than the sellers. And it's the contrary for a bearish candle, which is the red candle on the right. It opened higher and closed lower, and again the price moved up to a high, down to a low, and then closed. Now there's lots of different candles. I'm going to show you some of them in the next slide, but what is really important about this and often overlooked is that a lot of the information, most of the information that you need to decide what team you want to be on. Do you want to be on the buying team or the selling team when you place your trade? You can get this information out of the most recent candle and some of the past candles as well. It also helps you identify key supply and demand levels, the supports and resistances, and also gives you an indication of what's actually happening. It's a common thing when you ask somebody, but why did you take that trade? And they'll say, oh, because the indicator told me to. Now, okay, that's great, but actually, do you understand why you took the trade? Like, why is the indicator telling you to take the trade? Why is the signal telling you to take the trade? What's the actual mechanics behind everything that's going on? I think it's really important to understand these things before filling your charts with indicators, to actually keep thinking back to the concept of time and price. So when we look at these candles, they represent different time periods. So it depends what chart you're looking at. Are you looking at a monthly chart, a daily chart, 4-hour chart, hourly chart, 10-minute chart, 1-minute chart? So if it is, say, for example, a 1-hour chart, the information that you see in the candle represents a time slot of 1 hour. Now, in 1 hour, you're getting a pretty good understanding of what's happened. You can look at this over any time period, but also know the strength behind what that time period represents. For example, it's a very dominant hourly candle is going to represent a much larger strength position than a 1-minute candle. If you think of it as a team versus another team, in 1 minute you may have the bulls fighting against the bears. The bulls are winning, but in 5 minutes time a hell of a lot more bears turn up and completely dominate the bulls. I try and visualize that's what's going on in the background, because in fact it is what's going on. So when we have a look at the image on the bottom right hand corner, we can see that when you look at a 15-minute chart, there's lots of ups and downs, and that still represents the macro movement of a 60-minute chart and an even higher level movement of a 4-hour chart. You can see that the 4-hour is much smoother than the 15-minute. That's why I'm saying, like, on a smaller time frame, you'll see the bulls are winning, then the bears are winning, the bulls are winning, and it does really pay to have a look at a higher time frame just to get an idea of what's actually happening in the bigger picture, in the bigger scheme of things. I mean, maybe, you know, looking at a 1 month, I think that's too long to be representative of the style of trading that we do. I prefer to look at 30-minute, 1 hour, 4 hour, and daily. And for me, that's enough confirmation for the time period that we are trading in. If you're a much longer term trader, perhaps you'll look at longer term time frames, but also then fundamentals really do start playing a bigger role as well. Also, depending on what time frame you decide to trade, this is going to influence most likely your stop losses and your position size. And I'll show you a little bit more about that shortly. So let's have a look at some candle patterns. You can see this very first green candle. If you were to tell me the story about what's happening here, well, the bulls completely dominated the bears. We don't know how many at this stage because we don't have an idea of volume. In stocks or CFDs, you do get market depth and you do get volume, and it's relatively accurate, whereas in Forex, volume indicators typically represent the volume of that particular broker, and that particular broker is just a drop in the ocean compared to the actual volumes that are going on in the Forex market that we don't even know about, including institutional traders. But nonetheless, we know in this particular instance, the bulls completely dominated the bears, and for me that is a very strong candle, and it is for most technicians in Forex trading and actually any type of financial market trading. It's a very dominant signal. The second most bullish candle is also very strong, but there was a bigger battle going on. So what happened is the bulls were winning, the bears drove the price down, and the bulls continued to push up and push up and push up, and the bears did also get some form of strength into this candle. They did fight back a bit, but not good enough. The bulls were still dominant. Again, as you move along, you can start seeing what's actually happening. For example, this normal bullish candle, the price opened higher, it went lower, so it means at one stage this was a red candle and the bears were winning, but the bulls fought back, went past the open price, went all the way up to a high, and the bears fought them back down again. So it is bullish, but it's nowhere near as bullish as the first candle or the second candle. And as you go along from left to right, you can start painting a picture of what's actually happening in the background, and then you can start combining these together, and you can also see a larger scale, like more chapters to the story, so to speak. This just gives you that instance, whereas when you start putting 2 or 3 or 4 candles together, you can start getting a better idea of, well, how much support does each team have in today's trading session, for example. And if we look at the rectangle below, where it's representing all the bearish candles, it's just exactly the opposite to the bullish candles. So for example, the most bearish, it opened and the bears just won the whole way through until the candle closed. So when you're looking at these candles and you look at it on a 30-minute time frame, you might see this most bearish candle, but if you then look at a daily candle, you might find that the bulls actually ended up dominating the day. So for example, within a 60-minute candle, 1 hour candle, 1 hour chart, if you were to look at a 15-minute chart, there'd be 4 candles for every 1 candle on a day on an hourly chart. So if you're looking at an hourly chart, then you go to a 15-minute chart, 4 candles represent 1 candle in an hourly chart. Now this can give you some more insight to what actually happened in that hour. And you can break it down all the way down to 1 minute if you like. But that information is there. You can write a story about what's happened, which is really important. So that leads us to our next topic, is support and resistance. Now, support and resistance is a good indicator of volume at a particular price point. It means, for example, if you have this resistance line here, because the price is below the maximum achieved price on multiple occasions, it means that every time the bulls are trying to get through this price point, there's a lot of sellers available. There's a lot of supply at this point. So in order for the bulls to break through this price, they need to have more buying power, significantly more buying power than the supply that's available at this point. So it really needs to be not only a strong move, but a strong move with volume, because there's a lot of volume available at this point, as well as at the support level. Every time the bears are selling and offering supply to the market, at this particular support level, there's a lot of demand available. And it could come, you could speculate, but for example, institutions may say, well, every time, or even countries, every time the price is at this point, we don't want this particular currency to get below this point. So whenever it gets there, we buying. And they've got such a large amount of buying power that they can keep these prices up. And that happens for various reasons. But us as traders, it's important for us to identify these things, because being the drop in the ocean that we are in the Forex game, we want to just get on board with a winning team and bag a few pips. This also is representative in trends. So by drawing your trend lines for a resistance and a support, what you can get out of this is, we've identified, okay, this is an uptrend, but you might be looking for a good ideal entry point. And an ideal entry point would be when the price has hit the support line, because you know that most likely, in order for it to drop below that support line, there needs to be extremely strong selling power, or more supply than the demand at that point, and that basically gives you an opportunity to take an entry. So for example, for me, if this price came, I don't know if you can see this candle here, but there's one bullish candle where it hit the support line and then bought back up straight away. I'd probably enter on this candle for a long, because I can set my stop loss below the support line, relatively close, far enough so that there's room for movement, but close enough so that I can have a strong position size without risking too much of my account, and hopefully I can jump on for this trend. And I'm going to get not only the vertical movement up to the resistance line, but to follow the gradient that's going along. I mean, these aren't certainties. Everything we do in Forex is not certain. There's no 100%. But what we are trying to do is make sure that whatever move we make, we have some form of edge or advantage over the market, or we putting the odds in our favor as much as possible. Now, I wouldn't be entering along on a candle or when the price is near the resistance line. The reason I wouldn't do that is because it needs a lot of buying power to break through that resistance line in order for this price to go more vertical than the current gradient. And we know that the range of movement is quite easily between this resistance and support line. And I don't really want to be putting my stop loss that wide. I'm going to have to really take a small position not to risk too much of my account. And I'm going to show you on a calculator in a couple of slides time how big your stop loss actually dictates what position size you take. So in this case, I mean, you do get some traders who are counter trend traders. When it gets to this resistance line, they might take a short. I don't do that. I'm more interested in, getting a longer trend So what will happen is I'll wait. If I see it at this resistance line, I'd rather wait until we have a few red candles closer to the support, and then I'll look at jumping in if I've been signaled from the price action indicator. Okay, so identifying entries and exits, they are very important, and we do use candlesticks, we use trend lines, we use supply demand levels to help us identify these on multiple time frames. But then the second part is money management and psychology. So by determining our maximum loss, what we're willing to risk, we can then determine our position size, and we can also use that to manage our position. And this gives us long run positive expectancy. It's a combination of our system and money management, and further to that, your discipline and your winning attitude. So I'm not going to go through the slide on the stop loss and take profit. I believe we've all looked at that, but more importantly, I'm going to cover it in a bit more detail as soon as we get to this calculator. This here was some recent results. We did it in a previous presentation, but what I want to show you is that no account has a straight line. It's impossible. You win some, you lose some. You can see in our trading results for it was over 100 trades over a 1 month period. There was a case where we were in almost a 3% drawdown. We recovered, then we had some losing trades, and we had some winning trades, some losing trades, but overall it's a positive gradient equity curve. That's what we're looking for. We need to be able to sustain these times where you have losing streaks. We need to contain those losses so that when we're on a winning streak, we can benefit from it to the maximum. You don't want to lose your whole account or a significant portion on your account when things aren't really going your way. I'm going to flick through the next few slides quite quickly because we have covered them in other presentations. This one here is just quite important. I have gone through it before, but I'd like to just share it with you again. It's very common for you to win a trade, lose a trade, win a trade, lose a trade, or win 2 trades, lose a trade, lose 2 trades. But what's really important to understand is it is very possible to lose 12 in a row. I mean, this account had 428 trades, and there was an occurrence where we lost 12 trades in a row. Doesn't mean the system's bad, it's just how things are. Because there was also an occurrence where we won 17 trades in a row. So these things can happen. It's like when you play heads or tails, when you're flipping a coin. We know that it's a 50-50, but you do sometimes get 10 heads in a row, or 5 heads in a row, or 10 tails in a row. It does happen. But over the long run, if you flip the coin 1,000 times, you would see that it's 50-50. You're going to have 500 heads and 500 tails, give or take 1 or 2, for example. But let's pretend it's an infinite sample where you flipped it almost an infinite time. It will be 50-50 because that's what the math says. So this is true for your accounts. You need to have an account that has an advantage over the market, which is your system plus your money management. That is what is going to make your account grow. Okay, price action indicator, this is what we use. This is our proprietary system. It's an indicator. It sends us signals, and we trade this on a daily basis. What I'm going to do now is I'm going to shoot across to our trading calculator. First, let me shoot across to a MetaTrader account. Okay, let's go to a MetaTrader account. This one. Okay, there we go. Okay, so this has got price action indicator on it. You can see, it's given us some short signals. This indicator doesn't repaint, by the way. Once the signal's there, the signal stays there. But let's say, for example, we wanted to trade this most recent candle. Okay, it hasn't given us a signal, but it is just for an example. So we take a look. We see here, okay, the current price is 94. Let's write it down. 0.94399. Okay, and we work our stop losses on the average true range. So that's the average range of a candle for a certain amount of candles. We usually work on 14 or 20. So let's just say it was 20. So the current ATR at 6.7 pips, right, means that the average range of a candle in this 1 hour chart is 6.7 pips, right, for the last 14 candles, or last 20 candles rather. So what we're going to do is we're going to shoot across to our calculator, and we say, what's your account size? Okay, so account size, say it's just $10,000. This calculator doesn't take into account swaps or commissions, so we usually just keep it on, say, a max loss of 1% or 0.5%. We never recommend going over 2%. You must be you must like to take risks if you're going to trade that sort of height. But we'll keep it at 1%. We said that the ATR was 6.7 pips, 6.7. Remember, 1 pip is 100th of a cent. So we use a multiple of 2 for our ATR stop loss. That means that if the current position that we're in from our entry point moves more than 2 times the average true range, that means that the position we believe is going against us. It's no longer in our favor. It's no longer going the direction we thought it was going to go in. So we'd like to get out at this point. That's how we determine our stop losses. Some people like to make it 3 times, 1.5 times. It's up to you. I like to use 2. Okay, so we said that the current price is, okay, and we're doing a short position as well. So we'll fill in the short position section, 0.94399. Boom. So our max loss is $100, which is 1% of our account. Okay, there's spread as well, obviously, but okay, max loss is $100 plus spread. So it's just a little bit over 1%, which is fine. Our maximum lot size is 0.7, and our stop loss is 0.9453. Now look what happens if I decided to move my stop loss further away. So if I said, you know what, I don't think 2 times ATR is fair at the moment. I think the market is moving a bit more than that. It's a very volatile time. Let me give my trade some more room. So I'm going to make it 3. Look what happens to our maximum lot size. 0.47. Significantly reduces. And our stop loss moves further away. But most importantly, our maximum loss is still $100. Right? If you think that the market is not very volatile and you think that maybe, you know what, that's too much of a stop loss, I would like to be in this trade and it needs to go in my favor, otherwise I want to get out fast. Let's say you put your ATR at 1.2. Look how much bigger of a trade you can take. You can take more than double the size trade. So you can take 1.17 lots as your trade size, and your stop loss is much closer. I use this calculator before I enter any trade because it gives me my stop loss and it also gives me my lot size. So price action indicator does give me a recommended stop loss based on a similar calculation, but what I'll do is I'll have a look at what's actually going on my chart. I'll look at the hourly chart, for example. I'll say, you know what, let's go to, this looks like a very rangy sort of market on the hourly. Let's have a look at the 4 hourly. Okay, it's come out of a large downtrend and now it does seem to be ranging. Yeah, I don't, and it's close to the bottom of the range as well. If it's gonna go in my direction, I'd like it to go there quite quickly. Then in my calculator, I would actually probably use a 1.5 ATR because I want to have more exposure. I want more potential for profit. I want a bigger position size. This is how you can grow an account really fast because it's dynamic. You're not always using the same position size. You're mixing up your position size based on your stop loss. But what you're doing is you're controlling your risk. You're never losing more than 1% of your account. So just because you're confident doesn't mean you should use large lot sizes. And if you're not confident, doesn't mean you should use tiny lot sizes either. As long as the risk is no more than, say, the 1%, maximum 2% of your account, and you've done some analysis on what's actually happening in the market, done some analysis, you've looked at 4 hourly, you've looked at the daily. I can see it on this, the price for this Euro Chef at this point in time, it is relatively low. The sharp spike down that you see here, this was during, you know, the initial stages of COVID. A lot of stuff went on. It's recovered. Then we've had the second wave, and some other things have happened. So even though we're technical analysis, we do take into account what's actually going on. It has trended down. It is a downtrend, but at this level, it's formed some form of resistance. It seems as though there's a lot of demand at this level. There's a lot of buying power at this level. Is it going to bounce back up? Okay, I'm gonna get in on my long signal here. You know, there's varying viewpoints you can have at this point. You might say, no, I want to wait and see if it breaks below the supply level. It did test it, and it did break below, but it was bought back up quite quickly. You know, this is a very strong sign that the buying power here is strong, and it's tested it and tested it and tested it. So is it going to break through? And it's on a daily chart, so you know the volume is strong. Is it going to break through? Is it going to reverse up? And not only that, each one of these candles, I mean, they're quite large. You're talking about, what's the average ATR? Okay, that's saying 63 pips. But if I use the MetaTrader, just to see the range difference, what have we got here? We've got like 900 pips. You know, it's really big. Okay, yes, this ATR here is the hourly ATR. So we're on a daily chart. You know, there's about 900 pips movement in a day. So on a rejection of this support, breaking through the support on an hourly or a 30-minute chart, I'd probably be inclined to take a long when I get my long signal, just like what happened here. So obviously before, when we were talking, we were just saying, for the sake, if we were to take a short trade, there's no signal, so we wouldn't take a trade, but it was for calculated purposes. I'd be looking for another one of these opportunities here. So at this point, you know, I wouldn't be trading anything at all. I'd be waiting for my signal, because I believe in following your system. And once we get back down to this low point or near it, any long signal that we get, I'd get in. I'd probably risk 1% of my account. If I see it's got into a nice profit, probably to actually where the price is right now, and there was another long signal like there was here, I'd increase my position size so that I'm risking 2% of my account. So I've got double the volume position, and I wouldn't take my recommended stop, the automatic stop loss, take profit that price action indicator gives you. I'd be looking at this level, and I'd say, you know what? Because I've got two positions, I'm going to take one take profit here, and then I'm going to move my stop loss up, and I'm going to set the other take profit to around here. So out of the same move, I'm implementing, I've got a strategy and I've got a management plan. I've got an idea of how I want to manage this trade. For a stop loss, the stop loss is going to be 2 times ATR. It's probably going to put you somewhere down here as a stop loss. So if I'm wrong, I have to actually be wrong. I've got to be really wrong. I'm happy to give it a little bit of movement. You know, that's how I trade this. And you got to plan your trades. So figure out what your story is. Look at the different time frames. Look at the candles that the information that the candles are giving you, and then take advantage of things like this trading calculator. Okay, we developed this trading calculator. We give all our resources to people who sign up to HotForex with our affiliate link and have live accounts. But this sort of trading calculator really makes the management side of things easy. It's difficult to try and just keep everything in your head all the time. It's better to have it written down. It's calculated. It's definitive. It suits your plan, and then you're actioning it. Just like running any business, you need to have an actual plan. Well, guys, thank you very much. I hope you got some benefit out of that. If you have any questions, please feel free to ask me. And I'm going to make another video actually doing some simulation trades using the calculator and the price action indicator, just to show you like it in practice, in reality, now that we've actually spoken about it. Cool. Thanks, guys. Have a great rest of the weekend.